Hi there, and welcome to the first episode of Kristal Conversations. This is a new initiative by us, Kristal.ai, where we will call industry experts to come and give us their insights into major investment topics as well as trends. Today's topic that we will be discussing in further detail is REITs, or Real Estate Investment Trusts. On the hot seat today, we have Pratyush Rastogi, an expert, I would like to say, in this topic of REITs, who has an MBA from Chicago Booth, and after having spent close to a decade in various industries along the lines of capital markets, private equity, as well as startups, he is now managing a family office called GenR Capital. Thank you so much, Pratyush, for being here.
It's great to be here.
Excellent. So before we go into, dive straight into details about REITs, why don't we take a little bit of a step back, and if you could give us a little bit of background about yourself, what made you interested in joining a family office, and your investment experience till now.
Yeah, so I have a bit of an eclectic background, starting my career on the trading floor with Barclays, doing PE in India for a while, startups in the US, and then came back to Singapore and started the family office predominantly just to manage my family's capital. So as I said, the background's kind of been a little bit all over the place, but predominantly in the investing experience, I focused on fixed income and on equity. Like you, started my career right around the great financial crisis, or the global financial crisis, I should say.
At least you weren't at Lehman Brothers, though.
Well, so. I wasn't. But I remember you going through it, and that was enough for me. But I joined the industry 2 months before Lehman collapsed, and it taught me, and I'm sure it taught you a lot about how dangerous leverage and illiquidity can be, and just how short people's memories are, and the reality of really how, when markets really turn like that, what investors are meant to do versus what they do. And it really shaped my career going forward. Yeah. So
given the start of your career was obviously with extreme bouts of volatility, do you think that shaped your specific investment style?
Oh, absolutely. I think it certainly, it was funny because I was on the trading floor, which is known for its aggression, but my investing style is actually quite conservative. And there are a couple things that the financial crisis taught me, right? One, as I said, it taught me how dangerous things like derivatives are, excessive leverage are, how getting caught up with euphoria are. When markets are really good, everybody thinks that all they need to do is invest and things will go up. And we found out that was not the case, and in a very destructive way, we found out that was not the case. So it's really shaped the way I invest in equity, which is really quite conservative now, and I really focus on companies which I know well, which have really good management, solid balance sheets, and ones which I can buy at a significant margin of safety.
Okay. Yeah. And it was interesting, you earlier mentioned that you invest into equities as well as fixed income, which I think is a great segue into our main topic right now. Yeah. What do you classify REITs? And before we get into that, do you mind just describing what a REIT is for the benefit of our investors?
Yeah. So REITs are essentially structures which house real estate assets that command or that accrue rentals. So there are different types of REITs: hospital REITs, retail REITs, and corporate REITs are basically that house corporations. And I'll predominantly talk about Singapore domicile REITs. It's something I know a little better. But most of the major malls and buildings that you see in Singapore are owned by REITs. And typically the goal of the REIT is 90%, or by law, 90% of their pre-tax profit has to be paid out to unit holders. So it makes a really nice cash flow investment for people who are looking for consistency. Yeah.
So it's like an in-between fixed income?
So there's always this argument about, is a REIT fixed income or REIT equity, and different people have different takes. My point of view is again, you can classify what you want, but I like to invest in REITs for the cash flow purposes and not for capital appreciation. One thing I always say is like investing in REITs for capital appreciation is like going to a restaurant hoping to meet a celebrity. It's cool if it happens, and it does happen, but that's not really why you go to the restaurant or why you invest in the REIT.
Fair
but yeah, you can define it however you like. You know, there's some fixed income aspects of it. It's very interest rate sensitive. There's some equity aspects of it. In financial crisis, we saw REITs fall 30, 40, 50, 60% in some cases. So it has elements of both. But it's really, I think, whether it's fixed income or equity is less important. It's really more important of why you're investing the asset and what it's doing for your portfolio.
So that was interesting, right? In the financial crisis, when interest rates were being dropped by the central bank, yet this did not exhibit fixed income kind of characteristics.
Right.
In fact, it was more equity-esque.
Yeah.
So are you trying to say that does investing into REITs become a lot more difficult because you need to be able to analyze the balance sheet and the specific assets and debt on the company's books, and at the same time have a very big macro play? Because, as you were mentioning, these are very highly geared structures. Right.
So that's exactly right. They are highly geared, and that's why you have sensitivity to interest rates. Now, the financial crisis, frankly, I don't think would matter what you owned. Everything fell. So I don't know if interest rates being cut really had a huge impact. I think there's a lot of panic in the market and people just sold everything. And I think what I'm just trying to say is that it exhibited the same sort of losses that equity did rather than fixed income did. Bond portfolios fell maybe 20%, whereas equity fell 50% or so. Right. So that's essentially the comparison there. But yeah, certainly the case is that they are, and as rightly said, the way. Because they have to pay out their profits, REITs don't essentially have a compounding effect that you would of a normal stock that's earning profits and then reinvesting those. So in order to grow or to buy new assets, they have to take on a certain level of debt to do so, or they have to raise equity capital, which can have a diluting effect on the unit holder. Yeah.
Right. So the compounding, which as you mentioned, is like it's called the eighth wonder of the world by Warren Buffett and Charlie Munger. Knowing you for so long, both of our idols and mentors.
Right.
So
you are also one of my idols and mentors. So
thank you. But given that background of the inability of it to compound. And sure, it can generate like a 5, 6, 7, 8% dividend yield potentially. You're always earning, as you mentioned, because it keeps diluting its shareholding. You will keep owning a smaller percentage of that. So do you need to take into account a much larger safety of margin and have a much more concrete view on the macro side of things?
I mean, having a view on the macro side of things is fine, but in real estate, this is particularly hard to do. Real estate cycles are really difficult to time, and I don't recommend people try to do that. And I'm also no good at predicting macro. I don't know very many people who are. But that's what I said. If you're looking at a REIT as an equity product, then yes, there's a lot of more things you have to essentially look at. If you really want the capital appreciation, then you really have to time. But if you're looking at it as a cash flow generating product, right? Okay. Then that's less important. And what you want to focus on, I'll just kind of challenge you, or not challenge, but just make a comment on, not all REITs are dilutive. Some managers do a very, very good job of making sure that acquisitions are DPU accretive, and DPU being distribution per unit. Accretive rather than dilutive. Some do a far worse job of that. So if you're gonna pick REITs, one piece of advice is really look at the history of the DPU growth, and has that been growing over time? And if so, then the manager is doing a good job of making sure that any acquisition they're doing is actually is accretive to DPU rather than dilutive.
Okay. Yeah. So just taking another step back, then, when you look at REITs or a whole assortment of asset classes to invest into. At GenR Capital, do you wake up on Jan 1st of the year and you're like, I'm going to assign 10%, 20%, 30% weightage of my entire portfolio to REIT specifically? Or how do you try and like balance out the investing aspect?
Yeah, that's a good question. I think we're pretty unique in that regard because we're a family office. And also within family offices, we're specifically unique because we don't have an operating business. Whereas most family offices do. So they have cash flows coming out of that business, and their family office is really built for capital appreciation, right? Okay. Or to some extent for some really large and old families than for just capital preservation, right? They invest in fixed assets. And so for us, cash flow is super important because we need cash to come out of that business to feed their family and
to potentially go to restaurants and
potentially go to restaurants and support the REITs that we invest in. Yeah, right. So a lot of our focus is really on cash flow generating assets, and that's really how we think of it. So we do have a certain, obviously, we have a certain cash flow requirement in mind in terms of what the overall portfolio generates, and really that's our starting point for any sort of asset allocation.
Okay, so that's the top down to some extent, where you're looking at I need X% returns from this specific vertical.
Yeah.
Going into the nitty gritty now, do you try and how do you try and go about investing into a specific REIT? Is it equity fundamentals, price to book, trying to understand, analyze each building they own? By industry verticals, like you mentioned hospitals and corporates. Like, what's your thinking about this?
Yeah, so I like to focus on a couple things. One, good assets. And this is one nice thing about REITs, and when I say good assets, is that they can be really qualitatively observed. Right, and this is one thing that I think, for a lot of reasons, a lot of retail investors in REITs are retirees, and part of the reason is because they can understand REITs pretty simply, right? For example, say you own a retail REIT, right? You can go to the malls they own and see, are people there? Are people there on the weekends? Are they shopping? Or are they just kind of hanging around or not doing anything?
Right.
Or is there no crowd, right? Or you can go to a building and look at the directory. Are there marquee names there? Right? Do you see a lot of people coming in and out? So you can always judge the quality of REIT, and you live in Singapore long enough, you know which areas tend to hold their pricing power, their prestige, and that way you can know which REITs are have better assets than others just by
physically going and checking.
Physically checking them out. Then the next thing is you really want to focus on what management's been doing. Have they been dilutive? Have they been just on an acquisition spree, or have they really focused on what's best for the unit holder and really trying to be DPU accretive, right? And then the last thing you really want to look at is the balance sheet metrics. Now, MAS has done a good job of making sure that the excess leverage that I think used to exist in REITs before is no longer there. They kind of limit the amount of leverage they can take, a REIT can take. But that being said, there is some wiggle room there. And the other thing you want to look at is make sure interest cover is high enough. As you know, debt in itself is not an issue. It's the ability to pay that debt.
Right.
And certainly when interest cover starts to tighten or to fall, I get a bit concerned. Yeah.
Okay. I hate to do this, but any specific names that you have
that put me on the spot.
Viewers might be interested in?
I'm going to say the name and it's going to fall 20% tomorrow. That's usually how it works. So as I said, and I'll give you an example of types of REITs I like, and again, I'm don't want to say, don't want to disparage anything or really pump up anything, but let me give you. I like REITs that have been very stable. So let me give you an example. So hospital REITs. So let's look at Parkway. A couple things that you like about it. I like about it. It has some of the best hospital assets in Singapore. Gleneagles and Mount E. Right, which I think we can all agree that they're top-notch hospitals. Right. They have a very, very steady built-in rental increase into their contracts with their renter, who's also their owner, right? So that you're constantly seeing rents go up and up and up, along with inflation plus some margin. And then lastly, they've done a very good job of not diluting the unit holder. So if you look at their units outstanding, since IPO, it's been very, very steady.
Right.
So you see constant growth there. Now, that being said, it isn't one of the higher yielding REITs, right? But that's not a problem. Higher yield doesn't mean better REIT, and frankly, sometimes the opposite is the case.
Yep.
Yeah.
Indeed.
Yeah.
Indeed. you were mentioning about how, as a retail investor that we might have on our platform, they can go physically to the mall and they can see the number of people that are there and try and analyze the quality of the REIT, potentially at least on a holistic basis from that aspect. But then on the other side, you have this massive elephant called Amazon that is disrupting the full retail segment altogether. So within the retail vertical, I guess, of REIT specifically, have you started to like lower your exposure to that side?
We haven't started to lower our exposure because, frankly, the retail REITs have done a good job of handling this. Now, let me say a couple things. Now, I don't know what's going to happen 20 years in the future, right? Let's say Amazon, Amazon might take over the world. Who knows? We might all just be working for Amazon, right?
Indeed.
And certainly the case is that you have seen an effect on tenant sales. So tenant sales has been sloping downwards over a period of time. But REITs have done a pretty good job of handling this. So let's take the example of the largest REIT in Singapore by market cap, which is CapitaLand Mall REIT. 50% of their gross revenues, or gross rentals, sorry, I should say, comes from things like F&B outlets, movie theaters, gyms, and places which can't really be Amazoned away, right? Because people are still going to want to go and eat dinner, they want to go have a drink, they want to go watch a movie, work out. So they've done a pretty good job of handling that aspect of it. The other part of it in Singapore is you can't just build a mall. EURA controls what land can be used for mall development and stuff. So that helps to support pricing to a certain extent. So
do you focus primarily on Singapore REITs itself, or?
So I mean, we predominantly focus on the Singapore domiciled REIT. So some of those REITs are domiciled in Singapore but might invest in other places. But predominantly that's where we focus on, because it's just an area we just know a little better than say the US-based REITs, which I'm really not familiar with.
Excellent. Well, thank you so much for your time and letting us know all of this information about REITs. I guess before we end the matter, I know you got married at the beginning of this year. Congratulations on that. And so, diamonds or REITs, which is a better investment?
Well, I think my wedding ring's been a pretty good investment. So let's I'll go with that.
Let's hope it stays in the same finger then.
Right.
Excellent. Thank you so much.
Thank you. Thanks so much.
Thanks.